Hey, I'm Chris Parrish, Chief Investment Officer with Oak Harbor Financial Group in Houston, Texas. This is our investment team's midweek release when we examine a news item, headline, or story making the rounds from publicly available sources, and we ask, is it news or is it noise? Hey, before we continue, please take a moment to hit the subscribe button and the notification bell so that you will be notified when we upload new content. So here we go. This week's news or noise topic, the Federal Reserve and their balance sheet policies. Straight up front, viewers, this is news for your money for sure. I would say this topic has been the subject the investment team at Oak Harvest has messaged to our clients more times since the COVID market bottom in late March of 2020 than any other. Why? Because the Federal Reserve's job is first and foremost still about two things. It's about money, its availability, and its stability, and it's about employment and job creation. It's the Federal Reserve and their monetary policies and their policy changes that matter more to your money than politicians, elections, or weekly COVID statistics and weekly government economic data. Sure enough, for the first 3 weeks of 2022, we've been flooded by Federal Reserve members discussing upcoming policy shifts throughout the coming year in order to combat the rise in inflation we've seen the last 12 to 15 months that is partly due to their own actions of keeping short-term interest rates anchored near zero too long and maintaining their QE4 Treasury and mortgage bond purchases at too high a level for too long. So since December of last year, the chorus of economists calling for multiple short-term interest rate increases in 2022, which at first were 2, and now are potentially 4 more rate increases for the upcoming year, has grown louder. Recall, viewers, the Federal Reserve largely controls short-term rates, while market prices tend to drive longer-term interest rate. No one knows how many times the Fed will raise rates in 2022. However, the overall stock markets, as represented by the S&P 500, has now absorbed the talk of both higher overall interest rates, with the S&P selling off about 8.5% so far from its all-time high. That's pretty good in my book. For what it's worth, the person with the loudest voice and most influence on this decision, Jerome Powell, has been very measured and cautious about messaging the speed of the Fed's next move. The issue that is most worrisome for Oak Harvest investment team isn't the one of rate increases. We can monitor that at the market's response in real time. So far, the market volatility and overall S&P 500 decline is very typical of early Fed tightening cycles and very much in line with our first half 2022 outlook. Sloppy and choppy, higher realized volatility and a decline of 7 to 12% back towards the 200-day moving average of 4,400 to 4,450 on the S&P 500. Call it round-tripping November and year-end 2021 gains. It's the other tool the Fed has used for monetary stimulus that the market seems most worried about. That tool is its balance sheet and its QE4 policy. Our team has discussed and shared our analysis of the Fed balance sheet with our clients for now 2 years. There is only one precedent time period for the upcoming Fed balance sheet reduction, and it's not a perfect fit. Nothing ever is. What's that time period? Yes, if you've been watching our content, you guessed it. It's 2018. We've messaged for over 6 months that we expected the first half of 2022 to play out similar to the manner of 2018, and sure enough, so far it has. However, last time that the Fed stopped buying bonds for its balance sheet and started to let its maturing portfolio run off, which is also known as quantitative tightening, or QT, was back in 2018, and back then, real yields rose material at the same time as inflation expectations ground to a halt and decline. What does this mean for investors? It means, contrary to what you are hearing on TV or reading in investment newsletters, investments such as TIPS or inflation-protected treasuries would not, I repeat, not be good places to park cash for most of 2022. While retail investors are plowing money into those tools, big professional investors look to have been selling them, as that TIP ETF is now down over 3% year to date. That was barely outperforming the S&P 500 the first few weeks of the year. I ask you, is that an inflation hedge? As for the Fed's balance sheet and its expansion or contraction relative to the stock markets, viewers, our investment team was very early to the scene in the second quarter of 2020 discussing this correlation and following the weekly data. However, it is not, I repeat, not the singular reason for the stock market's large gains the last 18 months. Even if you argued the Fed's balance sheet to the S&P 500 return was a perfect correlation, which is the argument bears have been making for about 2 years, and no correlation is ever perfect. Guess what the correlation to the S&P 500 would be telling you? We have the data. We have known the Fed's schedule. We can calculate the percent returns. Here's the chart. As you can see, the rate of change is slowing. However, because the Fed has been very transparent in their actions, if you would have been told months ago in November of 2021 that the risk to the overall market in the first quarter was down to a level of the S&P 500 of about 4,400 to 4,450, well, that's about a minus 5.5% to minus 8% move down from November 4th. But that's up 20% year over year from where the market stood at the end of January 2021. This level on the S&P 500 coincides almost exactly to other metrics, triangulations, or chart projections for a market pullback in timing this cycle. That's a pullback in the S&P 500 towards its rising 200-day moving average. Viewers, this period of digesting Federal Reserve policy changes will be tough and more volatile than the last year and a half. If you're watching your portfolios daily or weekly, we ask you to try not to do it. We're doing it for you. And while we expect this volatility around the Federal Reserve and their policy to continue for the upcoming quarters, we do expect the overall markets to regain its footing and continue its bull market ways. But until then, the news you hear about the Federal Reserve, well, that news is investment newsworthy, and it will likely continue to cause tremors throughout the markets in the months ahead. From the whole team here at Oak Harvest, thank you for support and trust throughout 2021, and we hope we can continue to be your partner and provide you with value-added service in 2022. And viewers, feel free to give us a call here to speak to one of our advisors. Let us help you craft a financial plan that meets your retirement goals and needs first and your greed second. Call us here at 877-896-0040. We are here to help you on your financial journey into and through your retirement years. I'm Chris Paris, and have a great week.